In this video, we are going to talk about how people lose money when the market is going up. So, before starting the video, please like this video. Hit the subscribe button and turn on the notification bell for future updates. Investing in the stock market has historically been one of the most remarkable ways to generate income. Although, it doesn't mean every investor makes money. The market's volatility comes with dangers, and there is a chance investors can lose most of their initial investment, which means there's a chance they can make a lot of money too. Let's look into 6 reasons people lose money in the uptrend market. 6. They attempt to time the market. For example, it may appear simple to time the market by simply glancing at the stock chart and trying to purchase when stocks are low and selling when they are high. In reality, this doesn't work too well. Timing the market may appear intriguing, but the problem is that it might cause you to miss out on significant gains or an opportunity to purchase a stock at its lowest price. For example, when the market is up, equities may continue to rise and gain another 1,000%. You could be waiting for stocks to drop in price, which means you're missing out on a wonderful opportunity to acquire more profitable companies. 5. Purchasing bad stock. Most stocks are predetermined to gain value over time, but certain stocks are also predetermined to decrease in value over time. Stock price declines can be attributed to situations in which a company is losing money. The company is still in business, however, it is in a dying industry. This occurs when the acquired equities are overvalued when a stronger competitor enters the market or for other reasons. Overvalued stocks might cause you to lose money in terms of predicted income, even when the stock market is doing well, because the actual returns will be lower than the projected returns. The same is true for high-risk or penny stocks. These stocks can easily cause you to lose money, because they can quickly lose 50% or more of their value in a short period of time, even when the market is rising. Greedy is the number one reason why people invest in the risky or penny stocks. 4. Trading options. This is one of the techniques to increase your portfolio's leverage. By investing little amounts in trading options, you might earn a lot of money. For knowledgeable investors, trading options make a lot of sense, but most investors shy away from it. When you use trading options, it is pretty simple to lose your premium or what you paid for. This is because, even when the market is increasing, the value of trading options diminishes over time and eventually expires. Similarly, selling options and betting on the wrong direction of stock can result in significant losses, even when the market is high. As a result, sticking to equities is highly recommended. 3. Using margin to invest in stock. Like trading options, margin is another way to add leverage to your portfolio. Margin, on the other hand, can come at a high cost. When you trade on margin, you are borrowing money from a brokerage at a low interest rate, which means that you pay interest on them regardless of whether you are making or losing money. This gives you extra money to invest, but if the stock market falls, you'll get with the dreaded margin call. The brokerage will force you to sell your stock holdings in order to pay off the debt you incurred when you borrowed money to invest. This is the simplest way to lose a lot of money in a short amount of time. However, if you use the margin well, you might make a lot of money. The best approach is to put your money into something that's less risky to avoid such situations of losing your initial investment plus the margin you borrowed from your brokerage. 2. Amount of commission paid. Stock trading becomes more active while the market is rising. Because of the high frequency of trading, it's possible to rack up a lot of commissions, especially if you're a regular option or day trader looking for over-the-counter equities or other less liquid investments that aren't available at every brokerage. These costs can mount up and eat away at any profits you've made, as well as cause you to lose money when the market is rising. 1. Lack of portfolio diversification. Even when the market is booming, owning fewer stocks is a risk that can cause you to lose money. This is due to the fact that only a few stocks expose you to additional risk. For instance, Company X may make money when the market is going up, but the company you own shares might be losing money for one reason or the other. When you own one or two companies, you lose out on the benefits of diversification, which can help you offset losses in other sectors and, in general, allow you to make a profit in the long term. The stock market took a big hit when COVID-19 started back in 2020, but the technology and pharmaceutical industries, on the other hand, quickly recovered. Stocks that performed well during the pandemic have dropped in recent months, while other sectors that were hit hard during COVID-19 are performing well. If you own technology and pharmaceutical companies only, you have lost a lot of money in the last several months, while other sectors of the economy have shown to be profitable. You would have profited during the pandemic and the last few months, while other economic sectors were thriving if you had diversified across markets. So, that's it for today's video. What are your thoughts on our video? Please let us know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on the notification bell before you go. As always, I will see you in the next video.